Rohr here with an early, concise highlight on Wednesday, March 25th, 2015. It is currently 7:45 a.m. U.S. Central Time. Coming to you a bit later than usual because we are interested in how the U.S. durable goods orders came in, and in fact, they were quite negative. The expected increase of a couple tenths in the headline number ended up being minus 1.4, and the ex-transportation minus 0.4. Yet the equities aren't responding too much to that, and we'll have to look at that a bit more closely along with other factors as we get into the actual analysis. So what does all this mean to the markets? Well, apparently not as much as the bears would like. Maybe it was the strong offshore data, and maybe it was just a matter of the bad news is good news psychology after the market softened on some of the weaker news we saw yesterday, or even anticipation of today's durables. But this market is sitting just about steady so far today, right at the 2085 area. Now, that's important because that is still nicely above the more important, heftier historic congestion and the recent trading low, and this is where the Fed factor comes in, on the dip last Thursday after the Wednesday surge on the FOMC seeming more dovish than a lot of people expected. On the dip last Thursday, the June S&P 500 future, right on the verge of being front month, held right into 2075 to 78. There's also a current Fibonacci support right there, right around the 2078 area. And all that's important psychologically now, because if it were to be back into that whole lower range by failing that support, that would be an important sign that even the robust accommodative psychology from the Fed is not working to keep the trend up from, generally speaking, the levels that were achieved into and on the reaction shortly after the next day on the Fed accommodation. The, of course, bigger level above is 2090 to 88. And that's very important now because on the recent push up from the Fed activity, we also jumped back above that level, which was upside acceleration on the short-term trend, but it also 2088.70 is the old all-time high from back in December. You'll also note, depending on where the market can get back above 2090, effectively take away the most recent down break and get back above those important technical levels, you'll also note that the 30-minute MACD leaked out below its lower runaway band yesterday. Let's adjust that just a bit upward to be in line with the hourly, and the hourly MACD is sitting right near it. So there's much further pressure. The battle's going to be between oversold stochastics on the short term, 30-minute and hourly, and the market getting down into this more critical support, 75 to 78 area, and the degree to which the MACDs are trying to say the near-term weakness can feed on itself. If it should break 2075 to 78 next, there's other congestion along the way, but the bigger levels are going to be back down around 2060 to 58 again. You'll see how the market played around with that in front of the FOMC last week. And the bigger resistances, if it pushed back up, start around this congestion around 2100, but there's a 2106.07 high in the contract, and the 2117, very important as a tolerance on some important weekly oscillator resistance on the continuation picture. And that pretty much does it for the short-term view of the S&P 500.